And that what you all need to take advantage of is 1031 exchange. 1031 exchange allows you to purchase a property of equal or greater value, and you get to defer the taxes that you pay. So what happens when you purchase a property of equal or greater value, there are some rules which I'm going to give you guys, and make sure that you notate this down. In order to complete a 1031 exchange, you cannot touch the money. So no, you can't go on vacation, you can't pay a bill, you can't put a little bit to the side, you cannot do any of that. You have to take the money, put it in escrow, you have to identify a property within 45 days, you have to close on a property within 180 days, okay? And again, you cannot touch the money. That is the most important part. Because so many times, so many people will come to me and say, oh my God, I just purchased a property, but I spent a little bit of the money. I'm like, dag, you can't even take advantage of 1031 exchange, right? So that is so important. Well, guys, I do not. Okay. Well, guys, so here's the screen that I promised you all sent in 2022. Now in 2024, you can take 60% of the value. Next year is gonna go down by another 20%. So if any of you are interested in getting in real estate, now is the time, okay? So now back to this. The building is $250,000. You cannot depreciate, you can't do bonus depreciation on a building. So that's gonna give you a depreciation expense of $9,382. Then you have personal property of $87,000, which can be depreciated for the most part over 5 years. So if you take 60% of that, that'll give you the $52,200. And then you have land improvements of $25,000, which gave you a depreciation expense of $15,000. So which means that that took your depreciation expense from $13,454 to $76,582. Okay, so who would like a bigger depreciation expense? You would, right? All right, but it's also important for you to understand how this works and how this all impacts you. And don't worry, guys, we'll be able to continue this conversation because I know you guys are like, but how? I usually give the details. Anybody know me? You know I tell details. But let's just talk about the effect of being able to take cost segregation. So I told you Ashley had W-2 income of $80,000. She had rental income of $20,000. So that means she had taxable income of $100,000. Right? Then she has rental expenses of $23,000, and then she had depreciation expense of $76,582. That pretty much will bring Ashley's taxable income down to $428. So what that means is Ashley is going to actually get a refund of $30,000 or more. Who would like a refund of $30,000, right? So obviously there are certain things that you must do and certain things that you must execute on in order to be able to do a cost segregation analysis, and obviously you're purchasing your properties. But keep in mind, guys, taxes, the tax game favors real estate investors. And that's why I'm so happy I get to talk about it, because most times I'm always talking about business and I never really get to talk about real estate. But, so did I do my job with showing you how you can live tax-free with real estate? I did, right? I did. Okay, perfect. One last thing that MG said I better talk to you guys about is when you sell these properties. Too many times we're having a conversation about building wealth and having assets and leaving a legacy, but we're not really talking about how you are going, what it means when you sell this property. When you sell a property, you have capital gains taxes. If you're going to have capital gains taxes, right, what happens is that, what does that mean? You're spending more money with the IRS, you're spending more money, what that time is. So with a building, it's 27 and a half years, right? So in this case, if Ashley had a $500,000 home, her land, which is not depreciable, right? So if you got accountants that's depreciating your land, go back to them and tell them, listen, that's wrong, right? So land is not depreciable. So in this case, Ashley, which we'll talk about in a moment, Ashley land is $130,000. So if her land is $130,000, by the time she divides her home value over 27 and a half years, she now has a tax deduction of $13,454. Now, I just told you all that I'm gonna show you how you can utilize real estate to live tax-free. So this is cool, but but I just showed you how she did that just with real estate, right? This is how she got her real estate tax-free. What I want to show you, and what I want to talk to you about, MG said, Ms. B, you got to talk to them about cost segregation and bonus depreciation. So, what I just walked you guys through is how you're going to be able to have real estate and live tax-free, which is great. But I know so many people have W-2 income, have business income, and you're like, listen, I need to offset this income with these real estate losses, because while real estate is so amazing and you can write off so many things, you need to be able to utilize those losses against that additional income that you're bringing in. So what you have is cost segregation and bonus depreciation. Cost segregation pretty much is the process of, taking apart your property. It's looking at each element of your property and dissecting it, because guess what? I just told you that a building you can depreciate it over 27 and a half years. But your home is not just a building, right? It's made up of land improvements, it's made up of personal property, of HVAC, it's made up of so many different things. So in order for us to really maximize on our tax deductions, what we are going to have to do is we are going to have to conduct what's called a cost segregation analysis. Anybody currently conducting cost segregation analysis on their property? Has it been a game changer in terms of the amount of depreciation? You work with my firm to do that? That's right, girl. All right. So yes, so your cost segregation, it pretty much is dissecting your property, right? So if your HVAC has a useful life, which we'll go over it so it can make more sense right now, but what happens when you do cost segregation, you're pretty much dissecting your property. And guys, don't worry, I'll have a QR code so you guys can download these notes. I know that at MG, I only have a certain amount of time, so I know I'm going fast. Don't worry. Don't worry. I see everybody like, hold on. Don't worry, I'm gonna give you this entire presentation so you'll have it. So with cost segregation, pretty much what I was explaining was that, okay, so what I was explaining was that your home is made up of more than just a building, right? So because your home is made up of more than just a building, what you have here is, yes, the property was sold for $500,000, but then you have your building at $250,000, you have personal property at $87,000, you have land improvements at $25,000, and your land, which I told you is not depreciable, is $130,000, right? So what that means is your building, you can't take bonus depreciation with your building, right? So, oh, and let me go back. I'm sorry, guys. Bonus depreciation. Bonus depreciation is what makes cost segregation so good. Because while you're dissecting, when Trump came in office and he enacted the Tax Cuts and Jobs Act, what he also enacted was bonus depreciation. So typically your assets, let's say an asset like personal property would need to be depreciated over 5 to 7 years. What happened is that he said, no, you can take 100% of that. But now we're kind of late. We're late, but we didn't miss the train, okay? So bonus depreciation